if you like to use trailing stop and you're the sort of person that wants to sort of shoot for the sort of runners and the bigger wins, then it's a really good marker. And a lot of people tend to trail less.
Two traders, Darren and Walter, pull back the curtain on profitable trading systems, consistent money management, and profitable psychological triggers. Welcome to the Two Traders podcast.
In this episode of the Two Traders podcast, Darren and I look at that Swiss Army knife tool that traders use called the moving average. We look at how you can use a moving average to both find exits for your trades, find entries for your trades, and even how to analyze the market. Darren argues that the moving average is actually more valuable than support and resistance, and he'll explain why. Darren also reveals why when price moves across a moving average, you should definitely pay attention. How you can even take the simplest of all moving averages and create your own trading system. And finally, we wrap up today's session when Darren dives deep into the problems that traders run into when they see illusory moving average relationships on the charts and how you can avoid these. All this and more in today's episode of the Two Traders podcast.
Welcome back to the Two Traders podcast. I'm Walter. I've got Darren on the line. Hey, Darren.
Hello, Walter.
So today, Darren, we're going to talk about the moving average. And I'm reminded of this intelligence test, or maybe a pseudo-intelligence test, where they give the subject a paperclip and they say, tell me all the different ways that you can use a paperclip. And the idea is, I think it's actually more of a creativity test, but the idea is that the person who's more creative can actually come up with many different ways to use a paperclip other than the obvious, right? And so my thinking was today we're gonna jump into the moving average, right? And you thought it was a great idea. So today we're going to talk about the moving average and all of the different ways that you might use a moving average in your trading. So I'll start off by saying that I've got a list of them here. Maybe we can ping pong back and forth if that works for you. So I'll just do one.
Yeah.
And one way to use a moving average is that you can watch and when I first learned this, I thought it was amazing. You can use the direction that the moving average is pointed as an exit system, as an exit strategy. So let me give you an example. Let's say you're in a buy trade, okay, and you've got probably a really low moving average, like an 8 or something like that moving average. And so you're in a buy trade and you're in this, and you want to know when to get out. So what you do is you wait until the 8 moving average actually turns down. So it'll be moving up, of course, for most of your trade if you're in a strong uptrend, and it might go flat, all right, and just stay sort of horizontal. But as soon as the market closes and you actually see that 8 moving average dip down and actually angle downward, then you close the trade. So that's one use for a moving average. And can you give us one as well, Darren?
Yeah, one of my favourites is using the moving average as a dynamic trend line. So, you know, the sort of classic trend line entry, you wait for the trend line to break and then you wait for price to pull back to the trend line, and that's where you look for your entry. And essentially use a moving average the same way. So pick something around the middle. I like the 50 simple moving average. Wait for price to break over the moving average and then pull back and then take your entry there. It's just a simple trend line system. You can even use a break back over the trend line as an exit, although I'm not as keen on it as an exit as I am for an entry. So yeah, use it as a trend line, wait for price to break over and then pull back towards it. It doesn't have to touch it, just any pullback, and then use that for your entry.
Cool. All right, I've got another one. So in this way, I think this reminds me of a system that I used a long time ago, and it was exciting for me because it was the first time I actually made money in the markets. And what I did was I had a bunch of moving averages, but you could do this with just 2. And so you might have a really low, like a 10 moving average, and maybe a higher one like a 50. And what you do is you just wait for them to both be pointed in the same direction. So they could both be pointing up, for example, in an uptrend, and then you wait for the market to collapse. So what happens is the lower moving average moves toward the higher one, and then when it gets there, it bounces off of it, and so you get in on a trade right on that bounce when the two moving averages sort of compress and come closer together, and then the lower moving average, the 10 or 8 or 6 or whatever it is, it sort of turns away from the 50, and you get in there. So because what you'll see, of course, in most uptrends and many downtrends, is you'll see the market, these moving averages spread apart, get close together, spread apart, get close together. So you can use that sort of rhythm and time your entries based on that. So that's another really unique way, I believe, and fun way to use moving averages to time your entries. Any other moving average thoughts, Darren?
Yeah, there's another one very similar to that I like, where you use, say, like a 50 and a 30 or a 50 and a 20 moving average, and you look for one something that's trending, so you've got nice sloping moving averages, and then you look for price to pull back into that pocket, the gap in between the moving averages, and you look for your entry there. And if you kind of prefer a more a good value entry, and you like to get deep retrace entries, that's a really good sort of value place to look to enter. So you wait for a trend to develop, and then you look for a pullback into the gap between the fast and the slower moving average.
That's great. And here's one that they say, I don't know if this is true, but they talk about institutions using this really high moving average. Usually it's like the 200 is what they say. And they say, well, if the market's above the 200, we know we're in an uptrend. And if it's below it, we know we're in a downtrend. Now, of course, the market can chop around and stay up and down around the 200 as well. But the interesting thing about the 200 is it's really slow to move up or down. So it kind of just sits there, and it's kind of like a 0 point for a lot of traders, where they see this as the line in the sand, and we know the market's turned when it closes below the 200 or goes back above the 200. So that's another way to use a moving average. Do you have any other ones, Darren?
Well, the final one that I know that somebody uses is it's very good to trail your stop behind. So if you like to use trailing stop, and you're the sort of person that wants to sort of shoot for the sort of runners and the bigger wins, then it's a really good marker. And a lot of people tend to trail their stops behind the price, and it's not very good, because that swing point you're trailing behind is generally a key support and resistance level that people are watching, and institutions like to push price through to collect the stops. So instead, use a moving average for your trailing stop, and you'll find that you keep in those long runners much longer.
Excellent, yeah. And there's one more thing I thought of. You could, if you're a trader who likes to find those turning points, so you're always kind of looking for that reversal, that swing high, swing low, and you really want to hook into those. What you might do is you just wait for the moving average to turn around, so it doesn't have to cross or anything like that. You might use something else, like maybe you see it go to like a double top or a historical level that usually reverses at in your thinking. What you might do is wait for that moving average to turn around. And so if it's going up, it just starts to bend and turn lower, and then you get into the trade. So what that means is you're going to get in a little bit later than some others might, but it's also more likely that it's confirming, it's got more movement, more closing prices are behind your direction. So it's a little bit safer than for some people than trying to get in immediately and getting burned. So that's another way to use moving averages. So what are your thoughts about the moving average? Are you using it right now in your trading?
Yeah, I've kind of always used moving averages, really, and it's a way of looking at the bigger picture of price, and I really like them. And essentially, really, price, if you put your line chart on instead of your candlesticks or your bar chart, then essentially that's a 1 period moving average anyway. So we're kind of all already using a moving average, and it's just kind of saying, let's have a look at the slightly bigger period. And something I noticed once was quite fascinating was when a time frame crosses the moving average, you generally have reversal candle pattern on the higher time frame. So if you find a spot on your chart where the H4 has crossed over the moving average, you'll invariably see some sort of outside bar on the weekly chart, or some sort of reversal candlestick pattern on the weekly chart, and that happens for all of the time frames. And essentially the moving average is just giving you a little look at the higher time frame as well, which is another way of looking at it, really, rather than just a line.
Yeah, that's a great tip. So there you go. So you would see that happening on the lower time frame, and then you would, and then I suppose later on, obviously, you would look up to the higher time frame and see that sort of reversal setup. Is that right?
Well, yeah. I mean, it's kind of like you were saying when say you look at the H4 chart and there's a double top. If you wait for it to cross the moving average as well, then it's almost like a confirmation that the higher time frame has turned as well now. So you get a hint from the price action on your time frame, and then when it crosses the moving average, that's kind of like a second confirmation, and a really good way of timing your entries, like you said.
Yeah, it's excellent. I love the line chart, which is, as you say, it's a 1 moving average on the close, and that's probably one of my favorite charts. And I think that people listening to this, I challenge you to take a look at the line chart, which again is the 1 moving average, as you say, and come up with a system, because I believe you can, just by observing what happens on the line chart. I think that's a great place to start for someone who's wanting to simplify their trading, but kind of still want to have that feeling like you're relying on an indicator, and then, you don't want to totally get out of it. So you are in essence looking at an indicator. It's a 1 moving average on the close, and that's a great place to start if you want to set yourself up with a really simple system. So any final thoughts on moving averages?
No, I think that is it really. But they're a great tool, and like you were saying, then don't be put off because it's an indicator, because it's essentially a higher time frame price chart being shown on your lower time frame. So it is price as well, and it can be a really if you use it simply, it can be a great tool, I think.
Yeah, it's great. And as you say, it's sort of like a holistic view, because you're getting all of these candles are being put into the line that's moving, today. So it's not just looking at what's happening, today, unless of course you're looking at the line chart. but what you're seeing though in that line is all of, like, if you're looking at the 20 moving average, right? All of these, the last 20 candles are all sort of part of this line. So it's really good for people who tend to focus in and forget about the big picture, and they don't approach the markets holistically. If you have a moving average on there, you can't avoid that, because it's obviously, all that is going into the line. So it's a really good way to see recent activity in the market. It's a great tool.
Yeah. Can I just make one final point, Walter?
Of course, yeah.
There is one thing that I don't believe in, and this is this idea that price is attracted to the moving average. That to me is complete tosh, because we know that price moves, the velocity of price changes. It's just logic that it's going to return to the moving average. That's I mean, if it never returned, then that would be something worth talking about. But so I hate it when people say that the price is attracted to a moving average like a 100 or a 200. It's just inevitable. To me, that's logic. And the other one is that people say that price consolidates around a moving average. And again, that is just a complete optical illusion that's going on in your head. And if you get a marker and go back, whatever's on your screen, mark all the consolidations, and I bet you whatever you want, you're going to have a lot more consolidations that are not at the moving average than you are at the moving average. But it's just something about those two elements coming together, the price and the other line, basically, that this little optical illusion, your brain picks up on that and it discounts all the other information. So it's just, I see that a lot in trading where people kind of see stuff, they kind of blank out what they don't want to see, and they kind of believe this tiny little bit of information. So there are some fallacies about it as well, as I think logically about what it's really showing to you.
Yeah, that's great. And you know what, Darren? I think maybe in our next episode we can dive into more of these optical illusions and fallacies, because there are plenty of them out there. Does that sound good to you?
Yeah, that's great. Yeah, I'd like to do one of those next time, definitely.
Yeah, next time let's jump into that. I think that will be a really fun podcast. So until then, Darren, thanks so much for your time, and I really appreciate it. We will see you in the next episode.
Cheers, Walter. Goodbye.
Bye.